This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Thanks for joining us. My name is Bruce Norris, and today our special guest is Craig Hill. Craig and I go way back.
Yes.
And I remember thinking, wow, I've got to find source of money. I was buying too many deals. I was going to auctions, and I actually had somebody that worked for me at the time, and I had him door knock lenders, and you were the only one that said, yeah, I'll talk to the guy.
Right.
And so that's what started this. So we'll go over some of that, but why you're with the Norris Group was an interaction you and I had, me as a borrower, you as a supplier of money, where the appraisal came in wrong. Right. It was off by 20% easily. And at the time I felt like I was certainly probably your best client. And I just thought, Craig, can we ignore that appraisal and just do the loan that I thought was going to happen?
Right.
And you said, Bruce, not for you or anyone else will I ever push a value to accomplish a loan. And when I hung up, I actually made a mental note. If I ever start a company, I'm going to have you with me.
Right.
That's a big deal.
Oh, I mean, it's absolutely, yes.
You know, that what you showed me there was, because if you were paid on volume, I represented a fair amount of a paycheck, and you stood with what you believed in face of that. I don't think there's very many people that would do that. And I can tell you, for the last 25 years and I don't know how many hundreds of millions of dollars, I haven't lost one moment of sleep thinking, I hope Craig does what's right.
Right.
And that's a big deal.
Well, that's because I didn't want to lose any sleep either.
Yeah, it is kind of funny. We're built a lot that way. There's the 80-20 rule, and you and I have developed a pattern of just not doing the 20% that cost you 80% of the problems.
Exactly. Because that really, it just monopolizes your time if you have problems that you're dealing with instead of just focusing on business.
Yeah. And the way you and I are rigged, it occupies our head.
Yeah. 100%.
100% of the time. So you could have 95% of it good, but if 5% of it was not paying or in default or, oh my gosh, I got caught on fire, it's in such a bad area,
right,
we'd be a wreck.
Yeah. Yeah, exactly.
So you just have to realize, okay, that's we're both built like that. Now going back to those first loans, the hard money loan business, first of all, was completely different. How many investors did you loan to at the time I showed up?
Yeah, exactly. Hard money now is almost synonymous with investors. Yeah. When we met, it had nothing to do with investors. As a matter of fact, most companies really had a rule of not dealing with investors because their philosophy was the property's worth what you pay for it.
Exactly.
So you're dealing with somebody that's buying a house at 40, 50 cents on the dollar. It just kind of made everybody's head spin. Because they couldn't comprehend that. Now the house next door sold for 100.
Right.
You bought the exact same house for 50. Well, that one was worth 100. Yours was worth 50.
That's right.
So it was a challenge, as you know, those first deals, getting investors to comprehend that.
Well, we did 3 simultaneous loans, and I remember signing the loan docs, and it was a house I had bought at a HUD auction.
Right.
It was worth 85 grand. It basically needed the hedge trimmed. That was it.
Right.
I bought it for 34 grand. And so whenever we talked about what you could loan, it was like 60 or 65% of the appraisal. And I said, does it bother you? You're going to loan me more than I paid for it. And you just like, yeah, there was a little pause there.
Right.
And I realized that there was someone that owned the company that this was new to as well.
Right.
And so I probably made a pretty good strategic decision by making 6 payments on each of those loans in advance.
Oh yeah, absolutely. Peace of mind.
Yeah. And then I think what went off in the owner's head, And probably yours is like, okay, this is a different group of folks.
Right.
And man, we haven't looked back since. What was fun is you guys gave me $1 million credit letter.
Right.
And so I'd go to the HUD auction, I'd buy something for 40 grand and they'd cross it off. And that was a 960 letter. I always got a kick out of that.
Right. Yeah.
I thought, wow, that's pretty powerful stuff. I guess, can I get 2 of those?
Yeah. I was actually going through my desk a few weeks ago, just because we're going to probably move offices around. I actually found some of your old letters.
Oh, wow.
Some of your old pre-approval letters from way back.
Oh my God. Talk about not throwing away anything.
Yeah. I'm getting better.
I might want to see that myself.
Yeah.
That's pretty hilarious. Now back then, the impetus for the volume was lender-owned stuff. So I was going to auctions and it was all lender-owned. And in a way that's different. It's a different lending environment because title is usually pretty simple, right?
Right.
That's one of the things. Okay, if lenders own it, there's no first, there's no title issues. It already went through the foreclosure process.
Exactly.
So, and then everything was being bought pretty good discounts at the time. And then that lasted about 91 to 96. And there was a round of that. And then I remember thinking after 96, okay, what will we be doing? The lending business, I thought, probably would not do as well. And it turned out to be just another round of deals that came from different sources. Gradually, it all came from private owners.
Exactly.
And so, the courses that we taught at the time started to reflect that realization. They go, okay, all you do is, okay, if you're dealing with REO agents, that's great in that 91 to 96. It won't be usable again until 2008. What do you do in the meantime?
Right.
Okay, well, then you start doing mailers and talking to human beings that own houses.
Exactly.
And all of a sudden, okay, the loan business thrived and did it completely different.
Right.
And also did construction loans. So we had a chance to build 93 homes, which the Norris Group funded.
Right.
So that was pretty cool. A lot of times, this has always happened to us as we've grown, is that you've had to have conversations for the first time with people with money on a particular type.
Exactly.
Okay? So like, okay, he bought it for, 43, we're loaning him 60. This is why it's okay.
Right.
Okay. He bought this building lot. We're going to do a construction loan for the first time.
Right.
Those discussions are almost impossible to happen unless the basis of trust is as solid as a rock.
Yeah, they're really impossible because you can't talk to somebody for the first time as a money investor, and present them with something that they just can't wrap their brain around.
Yeah, or it's just it's a repetitive nature. In other words,
right.
And I know that even if it's a price difference or if it's an area that's different, there's always that moment of, okay, why are you doing that product, or why are we doing this location?
Right. And a great example of that is, you remember when we went from my previous position to when it was now the Norris Group, everything I presented to the investor was exactly the same, exactly the same, but they looked at it like it was from outer space. Just because something was different.
And that was it. Wow.
Yes. So it is interesting that the thought process behind the money side, you just have to have a certain way of looking at it from their point of view.
Yeah.
And try to see what their questions are going to be before they ask them.
That's one of the things that has been very interesting, because as you know, we had somebody come in with a check one time that I had lunch with, that he was going to fund a loan.
Right.
And he actually went home with the check.
Right.
Now, that would be an interesting recording, as to how did I do such a bad job? And what I did is I asked for a second one. Right. Remember, I was buying fourplexes up a storm.
Right.
And so he was going to fund a fourplex that was worth 140 grand. I had bought it for 60 grand or something. And that was basically the trust deed. But then I probably said, well, I have another one and another one, another one.
Right.
And I think it scared him. So it's not easy raising money for trustees.
No, I mean, and obviously I have a longer buildup to be able to do it. But one of my strategies with people that I've dealt with is especially initially, you just kind of talk to them about it. Here's what I'm doing. And usually you can wait for them to ask you, is this something I can do?
Okay.
If you're talking to the right people. In other words, it's just got to be something that is a natural conversation, and it's just built right into it. Once again, we're doing a little history here, but you may remember in the early days, we were much busier than we thought we were going to be at the Norris Group.
Right.
And we had a couple of those Moreno Valley loans, and I felt like I had one more call.
That was it.
From my list of people that I knew with funds.
Yeah.
And I had to make that call without showing any urgency that, this call has to go really well. And fortunately it did. And the gentleman turned out to be one of our better investors for a long period of time.
That's right. If somebody was here in the office, and I have been here now for the same time length as you, basically, and listen to your conversation, the initial conversation with the borrower.
Right.
So if somebody thought, okay, well, what's the conversation? What's the initial conversation with a borrower? If they think it's a sales pitch, they haven't sat next to your office.
Right.
It's kind of exactly the opposite. It's an interrogation almost.
Well, it is, because when you talk to a client like that, a borrower, you're really doing it for two reasons. One, you're doing it for the investor that's going to put in the money, of course.
Absolutely.
But also you're kind of doing it for that person.
Absolutely.
Especially when you get somebody that's relatively new or something, you try to ask all these questions because you just can sometimes see that they're not looking at the whole picture. And you want to make sure that they're looking at the whole picture even before they agree to do it.
Yeah. And a lot of times there's, that's what's nice if you have a hard money loan business that's got levels of protection, if you will. So you're not going to physically go out and see the property, but you're looking at the situation. First of all, you can see, well, where is it? Okay, well, shoot, it's in the middle of nowhere, or it's next to commercial buildings and apartments and across from a school. You can see that now on Zoom.
Yes.
There's a protection there where you go, okay, well, maybe you really should not do that. Or the margin is so tight that, after you pay this and this and this, you're just going to practice.
Yeah, exactly. Because usually people, when they first are starting to do deals, they're really not adding the numbers up right. They're kind of looking at gross numbers, highest, whenever it benefits them to be highest, they're highest. Whenever it's a cost or a negative, they always go lowest example. So a lot of times, I would say almost every time, they have a false sense of how much there is in the property.
And a lot of times what investors try to do is reach an appraisal number rather than let the number just emerge. And that's another barrier that's really important to have, is to have really experienced appraising done, like Rick Solis for years. He had flipped many homes.
Right.
And when he went out and looked at a property, it was through the lens of, I wouldn't buy this myself if it was not going to, if it wasn't going to be a good deal.
Exactly. Because so many people, I had one recently where it was, everybody's trying to say push is the right word maybe here, but because we know houses are selling for more than you can get an appraisal for in a lot of cases.
Correct.
But sometimes you're taking the highest numbers and then not realizing that there might be views attached with that. Yours doesn't have a view. You just got to make sure you're comparing it to comparable properties. And it's really easy once we send it, to Sean now. Sean Solis is Rick's brother. Mm-hmm. He's doing a lot of our appraisals, as is Holly. So they've kept up the tradition, and they're both fantastic and able to spot a lot of things that people might miss when they're trying to, say, force a deal in a market like this.
Yeah. And that's so important as an investor, because you're just going to mess up some. You're going to have to say that if you're the only person that ever looked at all the scenarios, you would be writing some checks, probably covering your mistakes.
Right.
So it's nice to have a few people looking out for you, going, yeah, that's, when Rick has said this, which has not been common, but he would say, yeah, that is not a trustee I would invest in.
Right.
That's the end of the deal.
Yeah, exactly. And even once again, this week, that the appraiser was looking at it and they made the comment, yeah, this house is built in the 70s. You definitely want one built in the 70s because anything under the 70s is not nearly as desirable.
Okay.
And somebody might see 62 and 74 and well, that's close enough.
Right.
But the appraiser knew that that wasn't the case.
And then that's a special thing, that every area is different.
Right.
When we did boot camps, we would have some appraisal examples. For instance,
right.
You go to Mira Loma and you look at a 1985 built house, 2-car garage, and you go to a 1960 built house with a 1/4 acre of land and a chicken coop, and it would sell for more.
Right.
And you're going, what the heck? Well, that was consistent. So what was important in Mira Loma was dirt, land.
Right.
And that's the appraiser's job, is to go, okay, it's a clean slate every time. What's important here could be very different.
Exactly.
And so that's why an experienced team is important. And and that's what's interesting too. A lot of times it's not easy investing successfully in trustees, by the way, because I know smart people that have earned the money and put it in trustees, and sometimes almost to 100% failure rate. They had to foreclose on them. So it's not an easy thing. So there's definitely, well, of course, I mean, since you and I have known each other, gosh, a lot of money is left institutional control, if you will, and they've gone directly to the borrower, people with money gone directly. And yeah, that's a barrier without it being there. That's dangerous to me.
Bruce, I have a question.
Yes.
So not really a question. This will just comment to Craig's experience. I take some of these loan calls sometimes, because he's on the phone talking to people. So, somebody who, maybe just has a few questions, I'll take it down the line. And I think I've got this wrapped up, like, oh man, I'm going to hand this over and this is going to be a loan. This is going to be a letter of credit. And then I head over to Craig and I'm like, hey, so-and-so called. And then bang, 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 like 4 questions later, I'm like, why don't you give him a call? Because he just hits me with things I never would have thought of, whether it's like, whether it's from where the location of the place is it 2 stories? Is it, all this that he's just, for all those years of experience, it's natural, and so it was just like, yeah, I got a long way to go.
Someone asked
and
me.
I have a good comment for that. I do. I think this fits perfectly.
Okay.
I think what can happen is when you're dealing with the first-time borrower, whatever the case, or a first-time, even if it's not first time, but you're dealing with the deal that comes in. Sometimes you can get caught up in like, okay, here's the predetermined outcome. And maybe you go through a series, what you think are checklist. And sometimes you get caught up in checking things off instead of listening.
Mm-hmm.
So with me, I kind of start off, and then based on the answers, it moves me to the next set of checklist.
Right.
So that's why I might come up with a little thing different, because I'm not looking for, say, ABC equals, okay, we can do this.
Right.
I'm starting at A, but then I might go over to 1, 2, 3. And you just really develop a sense that either the property might not be worthwhile. You might get a sense, and this comes up, I know, I hope most people would not want to buy this property, but sometimes it'll come up and I just get a feeling that maybe the client that's selling the property is older and might not be in full capacity.
Yeah.
Well, obviously that's just you tell the guy, and hey, just, obviously we're not going to do that.
Right.
So different questions you ask just bring up different concerns. And sometimes you don't even know where they're going to come from. Like you just ask a question thinking it's going to be this answer, and it's something completely different. And it takes you down a different direction.
Well, I've heard you say is it a deal or is it a situation, right?
Yeah.
Well, that's step number 1. If they leave a message, it's a situation. Usually you start with what is the situation.
Yeah. And those are the ones that people who chase yields fund.
Right.
And have a very busy life thereafter.
Right.
I remember years ago, somebody asked me about, how you made loans, or if I was familiar with the loan business, something like that. I said, well, I've sat next to Craig Hill for 25 years. I could probably answer or ask almost every question that I've heard him ask. The difference is he knows why he's asking the question. And, there's something about the hair on the neck going up.
Right.
There's an instinct that you have that's okay. Because I remember you saying, we look, it all looks perfect, but there's something that's gnawing at me. And sure enough, remember that thing, we didn't fund it. And there was a call, it was a flip to somebody else.
Right.
And it was something dishonest had occurred prior to that.
Right.
And had we funded that person that borrowed the money would have been in big trouble, and we wouldn't have been getting paid.
Exactly.
And we couldn't point to black and white why at the time.
Yeah.
But there was just in your brain, it's just like something's not adding up here.
Yeah, something's not right.
Well, that's when, those 10,000 conversations come into play, and it didn't add up. And that's invaluable. And if your intention is let's just fund a loan, you're going to have a lot of those situations that you wish you hadn't.
Yeah, absolutely.
When I first borrowed money, correct me if I'm wrong, but this is what I think I recall: 5 points, 12.5% interest.
Yeah, that's about right.
Yeah, okay. And I think I could have cared less.
Right.
Because what it did is allow me to fund another deal I was buying below 50%.
Right.
And I thought I just had died and gone to heaven. No kidding.
Yeah, me too.
I really felt like that because I thought, wow, I just have to perfect the skill of buying them. But now what's interesting is, behind my desk, there was always 24 files.
Right. Exactly.
And so there were always 25 payments of hard money loans. So you were making money on each property, but sometimes the closings were like not quite keeping pace with the payments. That's just one of those things. In the 2008 and 2009, that was a big deal because prices really crashed, and you came up with a great loan program.
Right.
And that made some of our clients multimillionaires for sure.
Right. And how we started it was the rental program.
Right.
And we first started it was, believe it or not, it was 9.9, and it was 8 years.
Yeah.
So, but at those prices, as you mentioned, it allowed people to cash flow.
That's right.
And they're able to get in and, carry the property. And now all the appreciation they've had over the, how long that's been?
Well,
12, 13 years.
Yeah. Past that. Sir. So that was a big deal, because once again, sometimes the loan business surprises you. So what are you going to do when, this situation comes up? And we've always adjusted, but that was really smart because obviously that was a long-term loan in place.
Exactly. And that was a circumstances that benefited the borrowers greatly because really nobody really was doing that at the time.
No, that was a big hole in the market.
Yeah. And one thing that we do whenever we have a program, it is truly hard money, meaning it's exactly the same process, same investors. There's nothing different about it except for the program.
Correct.
And that was another circumstance where it was a little bit interesting on the money side. Okay, here's what we got for you now. Something that's good. You're used to 1 year loans. Well, this is going to go 8 years.
Yes.
And
the yield was probably less than the hard money rate at the time.
Right.
But the interesting thing was it had duration, which means, you didn't get a payoff and then 3 months later get the money reactivated, that type of thing.
Right. I've always used the term with investors. You can go, would you like more yield or more money? Because you keep money busy 12 months out of the year at 9%. That's going to clobber 11% in and out.
Yeah, absolutely.
For sure, no doubt.
Well, that was a big deal for our clients that got to hold, and both sides of it.
Right.
What's the basic difference between the trusted investor and the property flipper or the property guy that holds the rental? I mean, as far as why they land on the square they land on?
Yeah, one difference might be the property and the money investor maybe has gotten there already.
Right.
Like they've already done those things, whether sell a lot of rentals, sold a business. So they're more in a situation where they're just trying to retain wealth,
right,
rather than gather it.
Right.
And that's why we've been a good fit over the years, because we've always focused on security first and yield second, although both are very good. We really understand that our clientele on the money side, they definitely they don't want to take risk or they'd be doing something else.
Yeah, that's interesting. Hard money loans sometimes, people get the impression that you're kind of funding a loan hoping for the person to default. I mean, there's no way we ever make a loan thinking that way at all.
Yeah.
And most of our lenders certainly don't think that way. They just want to check.
Oh yeah, exactly. Yeah. We're just on the mild side of that. I mean, once again, it's just, we want borrowers that make payments. Investors want to get payments.
What's the biggest thing that you think has, when you get an application or you have a first conversation with somebody, what do you need to see that you say, okay, I'm comfortable with what's going to go on? Yeah,
you kind of get it, just the general sense of somebody knowledge, I guess, would be first, because that's just from a conversation. You do that. You just kind of, what kind of knowledge do they have? Are they really even familiar with what they're trying to do? Then probably from there, you really want to make sure they're capable of doing it.
Right.
So that you kind of jump into that pretty quick. Because I don't think a lot of people, maybe they hear something on they've heard something at times where you can get into a property with no
Nothing
money
down. Yeah.
And, you really can't, unless you have a friend that wants to do it with you. I mean, which, okay, maybe you can do it that way, but whenever you're using a lender, you are going to have some money into the deal. You need to have some reserves. You need to be prepared for like consequences that you weren't expecting. So I think that's probably the number one thing, is just the liquidity to handle a deal.
Yeah.
You are looking at credit somewhat, not per se a score, but you want to see, is there anything that would prevent you from getting clean title, bankruptcies, judgments? You might want to look at somebody, and on a rare occasion, you see somebody that, this is just a general example, but they might have $100,000 of available credit cards,
mm-hmm.
and they have 99,800 owed against them.
Yeah.
Well, they're just one missed payment away from probably having a real problem all the way around.
Right.
So,
no, they need to get a no answer for their own sake.
Right.
This isn't a good additional risk, if you will.
Exactly.
Yeah.
Exactly. One thing, just to go back to the rental program.
Okay.
Because we still have it now, and a lot of people know that maybe, but if they don't, we only go 3 years now,
right?
But the rate is only 6.9.
Yes.
So that's still been a popular program, and it's probably been that way for probably close to 5 years now. It's been that particular program. So
yeah,
we still get a lot of activity on that, and plenty of investors to fund it for sure.
Yeah, and plenty to borrow too. So that's interesting. 12.5 turned into 6.9, and we still call it hard money.
Yeah, exactly.
That's pretty cool. The conversations that you're having now, you talk to all the people that call in. What's the mood of the participant, if you will? Because this is one of the craziest markets we've ever seen. That's legit in my mind. This isn't 2005 where people were buying homes with nothing down.
Exactly. I think it is. It's a very positive environment with regards to how they feel, especially on the ability to say buy and flip.
Yeah.
Because I think they know that if they get a house listed, they're going to sell it.
Yes.
So that part of it is very strong. And as you know, because I ask you all the time, a lot of them will just start with, what does Bruce think?
Yeah.
So we talk about that a lot. As you mentioned, the financing is much different now than it was. There's just a lot of different dynamics than there were back then.
Sometimes in these markets, investors try to stretch because there's competition every time they're making an offer. So do you find that they're trying to reach a number, maybe with a product that they don't really have the same thing?
Yeah, 100%. I mean, I always try to tell them, like, you should buy a deal. You shouldn't have to wait for it to be a deal.
Yeah.
Because that's kind of sums that up. In other words, they are looking to turn something into something they're not. And a good point that just popped in. Sometimes you'll get a client that like has a deal, and this kind of goes back to the conversation. They think their house is worth 600. Okay. Which frankly, it could be. Then you ask them, well, how much are you going to do in repairs? And they say 20 grand.
Mm-hmm.
And that's going to cover paint and maybe, new cabinet faces. Well, it's really hard to convince them that the reason that house sold for 600 and not 540 is because of the work they did.
Right.
So that's a very common thing, that they think they can do, like paint and carpet, as we say, and sell it for top dollar. So that's probably a mistake people make, is they don't put all the accurate numbers into the deal.
Yeah. So that is one of the flaws sometimes of investors. They're trying to reach so they can get a deal. So I'm doing a deal.
Right.
And then they try to sell it, and it's not the same house that the other one was.
Yeah. Because the deal works at 600 grand if they buy it for this.
Yeah.
But only if they put this much in.
Yeah.
And that it's unfortunate, but a lot of people do try to make things work that way.
Let's talk about the other loan program. So we've got the rental program at 6.9, and people are flipping.
Yeah.
So,
we still get a lot of flips, and basically we have a couple different programs. One is based off the purchase price, which is actually pretty popular because a lot of the buyers do have cash, or a lot of it. So the purchase price flip is 8.9%, 1 point. And with the right deal, that can be as little as 10% down on the purchase price.
Okay.
So we know that's competitive. And then we also have a program based on the ARV, and that's 9.9, 1 point. And once again, that can be as little as 10% into the overall deal.
Okay.
And what we mean by the overall deal is if you add up the purchase price of, $250 and 50 grand in repairs, that's 300,000. So you're going to have 30 grand, but maybe just 30 grand into the overall deal.
Okay.
So,
and how do we handle repairs? What do they typically do? Let's say it's under 100.
Yeah. Anything under 100, most of the stuff is typically probably 20 to 60.
Right.
And usually what we'll do is, we'll divide it into maybe 2 or 3 draws.
Mm-hmm.
So somebody will they'll do the work, send pictures. Based on the pictures, we'll release a half or a third, and then they'll finish the work, and then we'll release the balance. So they're always somewhat ahead of us, but obviously from the money side, you definitely want the property to be making progress.
Correct. And if it's over 100, that's a different situation.
Yeah. Whenever it's under 100, there needs to be fund control involved.
Over 100. Yeah.
Yeah. So usually with the clients that I deal with a lot, and even new ones, usually there's a way to structure it where you can try to get the number under 100.
Okay.
Because there's very few properties that we're going to do where there's a repair bill much over 100, if even at 100.
Okay.
Greg, as we've seen in the stuff that we're doing in Florida, supply chain disruption has impacted the time frame for new builds. Has supply chain disruption impacted the fix and flipper that's borrowing from us?
I don't know that the supply chain has as much as like permits and things, or in some cities seem to have slowed some guys down, but that seems to be correcting itself.
Mm-hmm.
So it definitely seemed like permits, because I had a couple larger projects that took well over a year.
Yeah.
Yeah. And luckily in both these cases, one probably, because it was one of the larger properties we've done, it probably went up close to $1 million in what they'll get. So, that doesn't always happen.
No,
but it was shocking how long the delays were in some of the counties.
Are we doing, I know we have clients that are doing ADUs. Don't know if it's come up. Are we doing loans with ADUs?
Yeah, we're doing some loans with ADUs. The roadblocks on some of them, like they want to be owner occupied.
Oh,
So that eliminates a lot of that market.
That makes sense.
But the other roadblock, at least for now, when you're trying to do an after repaired value, if you don't have ADU comps,
right,
you're usually just using like
Square footage.
a granny unit or
square foot edge
something
or
like
something like
so
that.
so you're not getting the full value. But we definitely have done a fair amount. A lot of them actually have been purchases where they're buying it with the intent to build it.
Okay.
So once again, it's a little bit of a challenge because a lot of times you don't have the appraisal for that, but there's quite a few clients that are doing that.
On a side note, I looked up, I don't know how I ran across, it was in YouTube, where they've now built an ADU that gets delivered to your site.
Oh, geez.
And it unfolds, and it's pretty cool.
Huh.
So you're installed in 8 hours. So you have to have the foundation. So there's
Right.
the plan, build the foundation. This crane comes in and this thing unfolds, and you got a 400 or 600. There's different modules that can be attached to it, but it's pretty cool because
Wow.
it comes furnished and everything.
Wow.
You're going, what?
Yeah. Technology.
Yeah. So it's like a new day. Some of these things going on. Well, Craig, thank you very much for bringing us up to date on the loan business and
Sure.
for all the history we have between us. It's been great.
It's been a great 25 years so far. That's for sure.
Yeah.
Jeez.
It's hard to believe that's the term we are using, 25 years.
Yeah.
Can I ask one last question, Bruce?
Yeah, sure.
I get a lot of calls from investors that are on the flip side that follow you, that want to get into the lender side. Craig, can you talk about, if that's available, or, the waiting list, is Florida an option, things like that, please?
Yeah, it is an option. It really, is it a good option? There's just so much money, just industry wide, if you will. So there's not a lot of opportunity in California. There always is some possibility. So I would encourage anybody to give me a call. We do have some different opportunities in Florida with some of the 3-party builds that we're doing. So that's something that might work for some people, wouldn't work for everybody, but certainly anybody that's interested on the money side, just give me a call and we can see what you're looking to do and if we do have a fit.
Okay. Our office number, 951-780-5856. And you can talk to Craig. Gosh, 25 years, it's flown by.
It really, it is amazing how fast it's went.
Been a ball.
Yes.
It really has been.
Absolutely.
Craig, the next time we're going to do a podcast just talking about baseball and hockey.
All right. Sign me up.
You'll have to leave me off the hockey segment. All right. Thank you.
Thanks.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.